That paper in your pocket, why is it worth anything at all? Same size, same paper, same ink. But one piece can buy you a house, and another is worthless outside its own country. So what's actually valuable here? The paper or the belief behind it? In this video, we're breaking down money, gold, and the hidden rules of getting rich. Stick around, because the last fact might change how you see your own bank account. Why is gold valuable when it's basically just a shiny rock? Humans have chased gold for thousands of years, buried it with pharaohs, fought wars over it, and locked it away in vaults, guarded like nuclear codes. But gold doesn't do anything. You can't eat it, it won't heat your home, and it barely has industrial use. So why does a chunk of yellow metal command thousands of dollars an ounce? The answer isn't chemistry, it's psychology backed by scarcity. Gold is rare, it doesn't rust or decay, and every culture on Earth independently decided it was worth protecting. That shared belief, repeated across centuries and continents, turned a metal into a universal store of trust. When paper currencies wobble, when governments print too much, when wars threaten to erase savings overnight, people run back to gold because it can't be printed into oblivion. Central banks still hold tons of it in vaults for exactly this reason. Its value isn't really about the metal. It's about the one thing every civilization has agreed on independently: scarcity plus permanence equals trust. Strip away the mythology, and gold is just a very old, very stubborn agreement that refuses to break. Why do interest rates control almost everything in the economy? Central banks move one number, the interest rate, and suddenly mortgages get expensive, stock markets swing, and businesses freeze their hiring plans. It feels disproportionate for 1 percentage point to ripple through an entire economy, but that single number is really the price of borrowing money itself. When rates rise, loans cost more, so people delay buying homes, cars, and expansions. Businesses postpone new factories because financing them is pricier. Consumers cut back because credit card debt grows faster. Demand slows across the board, and with it, so does inflation, which is usually the entire point. When rates fall, borrowing gets cheap, businesses expand, consumers spend more freely, and the economy speeds up again. Central banks use this lever like a dimmer switch instead of an on-off button, nudging growth up or down without wanting to crash the whole system. It looks like a boring number on a news ticker, but it's the throttle for global commerce. Raise it, and the whole machine slows. Lower it, and the machine roars back to life. One number, one enormous ripple. Why do stock markets sometimes crash overnight for seemingly no reason? You go to sleep, and the market is fine. You wake up, and billions of dollars have vanished. It can feel random, but markets are really giant prediction machines built on confidence, and confidence can flip in hours. Stock prices aren't just about a company's current profits. They're bets on future profits. If investors suddenly believe the future looks worse, whether from a surprise interest rate hike, a war headline, or a bank collapsing somewhere far away, they sell fast to avoid losses. One investor selling triggers others to worry and sell too, and that panic feeds itself. Automated trading systems make this faster than ever, executing thousands of sell orders within seconds based on algorithms reacting to the same headlines humans are reacting to. It's less like a single cause and more like dominoes already leaning against each other, waiting for one push. The company didn't necessarily get worse overnight. The story people were telling themselves about its future just changed, and stories move faster than facts ever could. What actually happens during a recession, and why does everyone dread the word? A recession sounds abstract until it touches your paycheck. Technically, it's usually defined as the economy shrinking for 2 consecutive quarters, but the real story is about a chain reaction. It typically starts small. Consumers get nervous and spend less, maybe because of high prices or fear of job losses. Businesses see fewer sales, so they slow production and stop hiring. Fewer new jobs means less new spending, which means businesses see even fewer sales, and the cycle compounds. Companies eventually start laying people off just to survive. And now those newly unemployed people spend even less. Governments try to break the spiral by lowering interest rates or spending on infrastructure to inject money back into the system, hoping to convince people and businesses that better days are coming. Recessions end not because a magic switch flips, but because confidence slowly returns and spending starts moving again. The dread isn't really about a definition on a chart. It's about how quickly a slowdown in spending becomes a slowdown in someone's ability to pay rent. Why does the Federal Reserve printing dollars affect people in countries that don't even use dollars? The US dollar isn't just America's currency. It's the currency the entire world uses to trade oil, settle international debts, and hold as a safety net. Roughly half of global trade gets priced and paid for in dollars, even between two countries that aren't American at all. So when the US creates more dollars or raises interest rates on them, it doesn't stay contained within US borders. A stronger dollar means countries that borrowed in dollars now need more of their own currency to pay back the same debt, straining their budgets. It also means imported goods priced in dollars, like oil, get more expensive everywhere else. A weaker dollar does the opposite, making other countries' exports less competitive because their currency suddenly buys less. Emerging economies especially feel this whiplash because so much of their debt is denominated in dollars they don't control. It's a strange kind of power. One country's central bank adjusts a domestic number, and suddenly, governments on the other side of the planet are recalculating their national budgets. Why does your credit score decide so much of your financial life? 3 digits, and suddenly you're approved for an apartment or rejected, offered a low interest rate or a punishing one, trusted with a credit card limit, or denied outright. A credit score is essentially a lender's shortcut for answering one question. If I give this person money, will they pay it back? It's built from your payment history, how much debt you're carrying compared to your limits, how long you've had credit, and how often you're applying for new credit. Miss a payment, and the algorithm assumes future risk, even if that one late payment was a fluke. Carry a high balance, and it assumes you're stretched thin, even if you always pay it off. The system rewards long, steady, boring credit use and punishes anything that looks unpredictable. It's not measuring your character or your income directly, it's measuring your behavior pattern with borrowed money over time. That's why someone with modest income but consistent habits can outscore someone with a high income but erratic spending. The 3 digits aren't judging your worth. They're estimating your predictability. And predictability is what lenders are actually buying. Why do wealthy countries keep borrowing money instead of just living within their means? It sounds irresponsible until you realize that borrowing for a government isn't the same as borrowing for a household. A country with a strong, growing economy can borrow cheaply because investors trust it will keep growing and keep paying interest. That borrowed money gets used to build infrastructure, fund research, or stabilize the economy during downturns, investments that can grow the economy faster than the interest owed on the debt. As long as growth outpaces borrowing costs, the debt becomes manageable relative to the size of the whole economy, even if the total number keeps climbing. Problems only start when growth stalls, interest rates spike, or investors lose confidence that the country can keep servicing what it owes. Then borrowing gets more expensive at the exact moment the country needs it most. Wealthy countries aren't reckless for carrying debt. They're leveraging trust the same way a business takes out a loan to expand rather than waiting years to save up cash. The danger isn't the debt itself. It's what happens the day the world stops believing the debt will get paid. What actually happens when a bank fails? Banks don't keep your money sitting in a vault waiting for you. They lend most of it out as mortgages, business loans, and car loans, keeping only a small fraction on hand for everyday withdrawals. This works fine as long as most depositors don't ask for their money back at the same time. But if enough people suddenly panic and rush to withdraw everything at once, a bank run begins, and the bank simply doesn't have enough cash sitting around to cover it, even if its loans are perfectly healthy long-term assets. Once one bank shows cracks, fear spreads to other banks because depositors start wondering if their bank is next. That's why governments created deposit insurance, guaranteeing your money up to a certain amount even if the bank collapses, specifically to stop panic before it starts. When a bank does fail, regulators usually step in fast, either selling it to a healthier bank or unwinding it in an orderly way so depositors get their insured funds. The failure itself is rarely instant. It's usually the final domino after months of shaky loans, and the collapse becomes visible to the public only once trust runs out faster than the bank can prove it's solvent. Why does the price of oil ripple into groceries, plane tickets, and even your online shopping? Oil isn't just fuel for cars, it's the invisible ingredient behind almost everything that moves. Trucks that deliver food to grocery stores run on diesel. Planes burn jet fuel refined from crude oil. Plastic packaging, fertilizer for crops, and the shipping containers crossing oceans all depend on oil-based processes somewhere along the chain. When oil prices spike, whether from a war in a major producing region or a supply cut by producing nations, the cost of transporting and producing nearly everything rises with it. Farmers pay more to run tractors and fertilize fields, so food prices creep up. Airlines pay more for fuel, so ticket prices follow. Even a package shipped from a warehouse costs more to move. Because oil sits so early in the supply chain, its price acts like a tax that touches every industry downstream, even ones that seem to have nothing to do with energy. That's why a conflict thousands of miles from a grocery store can still show up on your receipt a few weeks later. How do the wealthiest people avoid feeling the pinch of taxes the way regular earners do? Most people pay taxes automatically because their income arrives as a paycheck, with taxes withheld before it even lands in their bank account. But a large share of wealthy people's net worth isn't income at all. It's the rising value of stocks, real estate, and businesses they already own. Unrealized gains, the increase in value of something you haven't sold yet, generally aren't taxed. So instead of selling assets and triggering a taxable event, wealthy individuals often borrow against those assets, using them as collateral for loans at relatively low interest rates. They get spendable cash without ever technically earning taxable income. Meanwhile, the assets keep growing in value, often faster than the interest owed on the loan. It's a loop mostly unavailable to people whose net worth is tied up in a modest paycheck, rather than a stock portfolio worth millions. The tax system, built decades ago mostly around wages, still struggles to catch wealth that grows quietly on paper instead of arriving as a check. Why do some countries deliberately weaken their own currency? It sounds backwards, a government intentionally making its own money worth less. But a weaker currency can be a competitive weapon. When a currency loses value, that country's exports become cheaper for foreign buyers, making its factories more competitive on the world stage. A weaker currency also makes imports more expensive at home, which can push domestic consumers toward buying locally made goods instead. Some countries manage this deliberately by adjusting interest rates or directly buying foreign currency to nudge their own currency downward. This strategy has risks. A weaker currency also makes imported energy and materials pricier, which can spark inflation at home even as exports boom abroad. Other countries watch this happen and sometimes accuse each other of currency manipulation, since one nation's cheaper exports become another nation's struggling factories. It's a quiet, slow-motion trade war fought not with tariffs or soldiers, but with exchange rates, where the goal isn't a strong currency for its own sake, it's whichever currency value makes your own economy win the next decade.